Michael Kurtz, head of China research at Macquarie Securities, joins us here in Hong Kong. What's the view behind that? A PMI, if it's going to drop below 50, that's going to jolt the market, make the people panic a little bit.
Well, first of all, I think we have to be a little conservative on PMI in the sense that while it probably will reflect some slowdown from the previous month, there have been some signs in July that, in fact, activity may be bottoming or ready to pick up again, not the least of which, of course, was the improvement in steel prices that we saw in July.
So you're saying that Chinese stocks are bound to play catch-up at this point in time?
Absolutely. I mean, we see a lot of value in the China equity space right now, and most importantly, the main reason why that market underperformed in the first half had largely to do with the overhang of policy tightening. With the softening of PMI, we have the conditions coming together in the second half of the year that should allow not just the end of tightening, but arguably even the beginning of some loosening of policy towards the end of the year.
Where's value? Can you be more specific? One guest yesterday said perhaps the banks are looking pretty good.
I think there are two places to look. The first is in cyclicals and very deep cyclicals, and the second is absolutely the banks. You look at banks, for example, like Bank of China, Minsheng Bank, you can get them at sort of 1.4 to 1.6 times book value, and they're still selling at single-digit PEs right now. So there's a lot of value there. And also, if you look at the cyclicals, names, for example, in materials, in transport, in some of the consumer-driven and externally-driven consumer plays like the tech hardware makers in China, there again you see lots of value. I'm talking about sort of 30 to 40% discounts to long-term average PER multiples.
Michael, are you looking at a liquidity rally? Some people are saying that with the government saying they will keep policies stable, that could perhaps drive a liquidity rally.
Well, certainly I think the tightening is largely in the price at this point. How much of a liquidity-driven rally we see in the second half may now begin to hinge more on the Chinese retail investor, who have been very reticent over the past 6 months or so, but with extremely low interest rates in the Chinese banking system, and therefore very little reason for depositors to leave their money in the bank in a situation where CPI is running at about 3%. We could see that household liquidity coming back out of the banks, back into Chinese real asset and financial asset markets in the second half.
And talking about assets, we have to talk about the property sector. Bubble, no bubble, do you want to get in or not?
Broadly speaking, household incomes have risen at 13% per annum over the past decade. Property prices have risen at about 10% on average per annum. So affordability has actually not deteriorated, broadly speaking. This is a sector that's also very undersupplied, about 3 months of outstanding inventory, maybe 4 months of outstanding inventory, which suggests that actually the conditions here for property demand to continue to look pretty good once the policy overhang is out of the way is actually pretty strong.
But the risks remain, though, yeah? Fundamentals are not terribly in place.
Well, yeah, we've seen the end of property tightening for the time being. That's very definitely not the same as a loosening of property conditions. And frankly, if we wanted to play the property sector right now, I would look upstream in some of the construction materials, cement and steel, rather than necessarily the developers themselves.
Those who choose to stay out of the China market, what would you say to them?
Well, there are opportunities outside of China. And frankly, one of the most important marginal demand stories in the second half of the year and looking into 2011 is actually going to be demand out of the U.S. from corporate spending, capital expenditure. And so outside of China, I think investors could be looking at IT and capital equipment plays in the markets like Korea and Taiwan that are much more U.S. focused, much more export driven, and much more intense in high tech and capital goods.
Michael Kurtz, thank you so much for your insights today.